On Tuesday, Tesla did something it had never done before. Over the past 12 months, the company pulled in more than $100 billion in revenue, record deliveries, record quarterly revenue. By almost every headline number, this was the best quarter Tesla has ever reported. And then the very next day, the stock fell 14.5%. Its worst single day in over a year. That doesn't add up. Best quarter ever, worst day in a year. How do both of those happen at the same time? Because underneath the record headline, something broke. Tesla is still selling cars faster than it ever has. It's just barely making any money doing it. Over the next few minutes, we're going to break down exactly what happened in Tesla's second quarter. The numbers Wall Street loved, the one number that scared them, and the single question every Tesla investor now has to answer. This is AlphaLens. Let's start with the setup, because to understand why this quarter rattled the market, you have to understand what Tesla actually is. And it's not just a car company. Tesla runs a vertically integrated, direct-to-consumer model that's built very differently from a traditional automaker. There are no dealerships. Tesla sells straight to you. It writes its own software and pushes updates over the air, the way your phone does, which opens the door to recurring revenue that legacy car makers simply don't have. It builds its own batteries and assembles its own cars in-house, instead of leaning on a web of outside suppliers. And it operates under a single global brand, rather than juggling a dozen sub-brands. That direct model has a powerful advantage. Tesla controls its own pricing in real time. It can raise or cut prices across the entire lineup overnight. And that, as you're about to see, is exactly the double-edged sword at the center of this quarter. So here's what went right, and plenty did. Tesla brought in $28.2 billion in revenue for the second quarter. That's up 26% from a year ago, and it came in comfortably ahead of the roughly $26.4 billion that Wall Street was expecting. Deliveries hit a record, around 480,000 vehicles. The energy business, the part of Tesla most people overlook, kept climbing, with storage deployments up more than 40%. Services revenue grew 50%, and for the first time in its history, Tesla crossed $100 billion in revenue over a trailing 12-month period. On the top line, this was a genuine blowout. Now let's talk about where the money actually comes from, because Tesla's revenue is really 5 different businesses stacked on top of each other, and they're not all healthy in the same way. The first and biggest is automotive sales. Model 3, Model Y, S, X, the Cybertruck. This is still around 80 to 85% of revenue. And right now, it's the problem child. Tesla cut prices to keep those record shipments moving, and those cuts are visibly eating into profit. Record cars sold, yes. But at a cost, the market is punishing in real time. The second stream is regulatory credits. For years, Tesla sold emissions credits to other automakers who needed them, and that was almost pure profit, money that cost Tesla nothing to produce. But here's the catch. As other car makers build their own electric vehicles, they need Tesla's credits less and less. That high-margin cushion is structurally shrinking. Any serious analyst strips this number out to see what Tesla's core business really earns. The third stream is energy, the megapack for utilities and the Powerwall for homes. This is the most underappreciated part of the whole company. Energy is growing faster than the car business. It carries improving margins, and it's tied directly to the global build-out of the power grid and the enormous energy demands of AI data centers. Most analysts barely cover it. That may be a mistake. Fourth is services. And the crown jewel here is the supercharger network. It's the densest, most reliable fast-charging network in North America, and Tesla has started opening it to other companies' electric cars. Think about what that becomes. A toll road. Every non-Tesla EV that plugs in pays Tesla. It's high margin, recurring, and it grows with the entire EV market, not just Tesla's slice of it. And fifth is full self-driving and autonomy. Today, the revenue from this is tiny, but the market isn't paying for what it earns today. It's paying for what it might become. And that brings us to the bull case. Because if you're optimistic about Tesla, your argument has almost nothing to do with cars. It's about four things. First, autonomy and robotaxi, the single biggest potential prize in the entire story. If Tesla's self-driving technology genuinely works at scale, Tesla stops being a company that sells cars and becomes a company that runs a fleet of robotaxis, earning money per mile around the clock with no driver to pay. In that world, today's stock price isn't expensive, it's cheap. Second, Optimus, Tesla's humanoid robot. It's early, it's speculative, but Tesla's expertise in AI, motors, and manufacturing gives it a real shot. If humanoid robots become a mass-market product, that market is bigger than cars. Third, energy storage, which can keep growing no matter what happens with car sales. And fourth, that supercharger network, a platform business quietly hiding inside a car company. But every bull case has a bear case sitting right across the table, and Tesla's is specific and current. The most urgent risk is the one this quarter exposed: margin compression that may not be temporary. Operating income didn't just dip, it collapsed 57%. Tesla's operating margin fell to just 1.4%. For a company that used to run double-digit margins, that is a stunning number. And for the first time in over 2 years, Tesla burned cash. Free cash flow went negative by more than $1 billion. If price cuts keep dragging margins down toward ordinary car maker levels, then the premium the market has always paid for Tesla becomes very hard to justify. The second risk is competition. BYD and the broader wave of Chinese automakers are now serious global players, building compelling electric cars at prices that pressure Tesla everywhere, from Europe to Southeast Asia. Tesla's head start is being competed away faster than the bulls expected. Third is a risk analysts don't love to say out loud, but they have to. Elon Musk himself. His public and political visibility has measurably affected Tesla's brand in key markets. European sales in particular have shown weakness that tracks with shifting sentiment. Tesla is more dependent on one person than almost any other company its size. Fourth is regulation and technology risk around self-driving. The robotaxi dream needs regulators to say yes, needs a strong safety record, and needs the technology to keep improving. And Waymo already has a real operational lead in the cities where it runs. One serious setback could deflate the whole optionality premium. And fifth is valuation itself. Even after this year's decline, Tesla trades at a price that assumes the AI and autonomy bets pay off. Value the car business alone, like any other automaker, and you'd get a dramatically lower number. Investors are paying for a future that's plausible, but not guaranteed. So how should you actually think about Tesla? The most useful way is to stop treating it as one stock. It's really three. There's Tesla the automaker, which on traditional math is worth less than where the stock trades today. There's Tesla, the energy and infrastructure platform, which is growing, improving, and underfollowed. And there's Tesla, the AI, autonomy, and robotics option, which is where most of that premium price actually lives, and which is a high-stakes, long-term, all-or-nothing bet. What you watched this week was the market stress testing that third story, while the first one visibly weakened, which leaves one number that matters more than any other going forward. Tesla's automotive gross margin, stripped of regulatory credits over the next couple of quarters. That's the whole ball game. If Tesla can show those price cuts are stabilizing and that scale and efficiency are starting to rebuild margin even a little, the bull case holds, and this sell-off was an opportunity. If margins keep sliding with no recovery in sight, then no amount of Robotaxi or robot headlines will stop the premium from bleeding away. Optimus, autonomy, energy. All of it is secondary until the core question of profitability is answered. Watch that margin number above everything else. If you want to run this exact kind of institutional breakdown on any stock yourself, AlphaLens gives you 15 professional research frameworks in seconds. The link and a free trial code are in the description. And if this helped you think more clearly about Tesla, subscribe. We do this every Friday.